Hello, I'm Mitch Goldberg. Welcome to Be the Boss of Your Money. This is my live stream. I do this every Monday through Thursday at 4:30 p.m. Eastern Standard Time. It's all about personal finance, investing, the stock market, the economy, and the tools, techniques, strategies that you need to become the boss of your money because you don't want your money to be the boss of you. Thank you for joining me. We're talking mostly about the lack of a NASDAQ slash ARK investor bounce. And we're going to answer a couple of questions as to how should I or you think about tech stocks. Because once I talk to you about this, I think you'll have a better view. The question I'm getting now is, should I buy ARK, ARKK? That's the big ETF that everybody talks about. Kathy Wood is the manager. I'm not disparaging her. I'm just saying it's been a super hot fund because it caught a super hot group of stocks in an unusual time period. We spoke about it yesterday. You see that ARK down 30% from its high. You see the crashing rockets there. So we spoke about that, and I want to make sure I follow up on a couple of things. And I'm asked, hey, should I get into Bitcoin or Dogecoin, whatever? We talk about these things a lot because these are the topics of the day. But I do want to make sure we focus on some personal finance matters too, not just the investing part. So I'm going to roll the intro real quick. We're going to talk about ARK, the lack of an NASDAQ bounce. What does it all mean? And are you positioned properly to move forward? Because I think a lot of people are still loaded up to the gills on the hottest stocks of 2020. And now they're scratching their head thinking, gee, I'm down a lot all of a sudden. Should I wait for the rebound? Should I just say, oh, it doesn't matter. I'm a long-term holder. A lot of people who buy a stock for it to go up pretty quickly, then the stock goes down, and all of a sudden they're a long-term holder. Remember why you bought a stock. And if it doesn't work out, you're allowed to change your mind, of course, but the situation that you were looking for is no longer there. That's what we're going to talk about. So here's the quick intro, and then we're going to roll with it, and it's going to be a good show. Stick around. I'm going to make this short and sweet. Welcome to Be the Boss of Your Money. This is my live stream. It's all about personal finance, making you the boss of your money, not your money, the boss of you. So here are the rules. If you have any questions, please ask me in the comments. I'll see them. I'll answer them. It's my favorite part of doing this, and it's the whole reason why I do this. So if you have any questions, ask in the comments. Words of wisdom, words of encouragement, a nice hello. That's always appreciated here in Be the Boss of Your Money as well. Couple of things to talk about. So how we work the show is we do a quick update in the market with some perspective. Then I get into the heart of the matter. And then in this case, where's the NASDAQ bounce after yesterday's big hit? And I want to give you a way to think about tech stocks that I think will guide you for a long time. All right. We've seen some really bad times in tech. And basically, if you've been in the business since the year 2000, I've been in the industry since 1990. But if, people who lived through the 2000 tech wreck are like, myself included, we're permanently scarred. And the experience does help us contain or curb our enthusiasm, if you will. So we're going to talk about that. So the first thing we're going to do is take a quick look. I'll do a quick share screen. I know how you love the share screen. I know you guys go nuts for that. So here we go. Put myself up in the corner over here. By the way, while you're watching this, especially in the live, if you give it a reaction or something, I'll see it. And that's cool. I get to see who's watching and I get to give you a shout out. And that's always a lot of fun. Questions in the comments and we can get very specific. And I hope you stump me. I want you to ask me a question that is like totally messes me up. because then I really have to think. I have to go back to the drawing board and learn, and I love learning. All right, so the Dow up 97 points. That's a new record for the Dow, led by stocks like Dow Chemical and Chevron, the same economically sensitive stocks that pushed it up yesterday. NASDAQ goes down, was up earlier today, but down 51 points. Ordinarily, that's not a big drop, but after yesterday's drubbing, there was no bounce, and the S&P was basically flat. Gold was up a bit. Gold is just stuck in the 1700s for a long time. Oil finally backed off at the end of the day, but it did trade higher earlier today. The 10-year Treasury below 1.6%. VIX, the Euro US, the Euro dollar 1.2. Not something that I pay as much attention to as the other indicators. The VIX still under 20, so I still think that's healthy. But if the VIX goes appreciably above 20, I think it's indicative of some pretty swift downside risk. Okay, that's what I think. Downside risk. Okay, bada bing, bada boom, bada bang. Here is the Dow. So Goldman Sachs, Golden Slacks up $8 a share. Caterpillar moving up despite a shortage of semiconductor chips, because Caterpillar equipment, it's like cars today. A lot of technology gets built into these things. Chevron up to 108. 3M, JP Morgan, Amgen, American Express, Merck finally catching a bid. McDonald's, who was at the bottom of the heat? Okay, Boeing. This is really disappointing because Boeing was touted as, by yours truly, as a major reopening stock. And as people start flying more, airlines have to start buying more aircraft, and, we're back in business. The MAX jets are certified to fly. They are flying. We really need to, we've got to see something from Boeing. There's a lot that rides on Boeing, no pun intended. All right, so let's keep going on. Crypto. All right, Bitcoin had a nice bounce today, up to almost 57,000. Let's look at Dogecoin. That's the one everybody likes to look at. Dogecoin was up to like 70 cents. It closed at 61 cents. These trade 24 hours a day, so you could just follow these all day long. Ethereum up again, up $63, up 1.8%, just about 2%. So good day in crypto land. Let's take a look. Healthcare had a pretty decent day also. Big numbers from CVS, Merck catching a bid, like I said before. Eli Lilly moving on up. Moderna, let me just see how Moderna is off $10. Why? The United States has decided that they're going to share the or break loose the copyright protection on the COVID vaccine so that other countries could rapidly produce them on their own. I mean, think of it this way. India is the biggest producer of medications in the world. Not that they invent them, but they that's where most of the manufacturing is. But they can't get enough vaccine because it's Moderna and Pfizer. But we'll see how it goes. I don't think anybody's disputing it, and maybe somebody will have to make up some losses to Moderna and Pfizer because they do have patent protection, right? So let's talk about ARK Investors, ARK Investor Fund. So it was down yesterday, took it yesterday, and it took another hit today, down $1.74, trading a little bit lower in after market trading. And if you look at a 3-month chart, if you look at the 3-month chart, it's not a big deal if it doesn't come up, because it's just when you go live, things take a little bit longer to work. But the expense ratio on ARK is 0.75%, which by today's standards for even a sector ETF is pretty gosh darn high. It's down over 10% year to date. The NASDAQ is up about 5.75%, just to give you an idea. So you live by the sword, you die by the sword. Just want to punch up XLK. You know what? Let's take a look at the sectors, and then I'll punch up XLK. XLK is the big technology ETF. All right. So let's just get to sector ETFs. By the way, this sector is ETFs. This is what I look at every day. And if you're not looking at this, you should be. This tells you right away what's working in the market, what's not. It just gives you a really good quick snapshot of things. But the winners of the day, energy. I just want to say that I've made a couple of videos, a couple of live streams saying that energy is a place to be, not a place to run away from. About a week and a half ago, I reiterated that. And I spoke about, yes, people are moving to Tesla, electric cars, surface fuel demand will plunge. I don't think it happens so fast. And right now, demand for oil is really going up, especially because inventories are also pretty lean. Building materials up, financials up, healthcare up, industrials. When you see industrials, financials, building materials, and energy go up, that's just, as of now, people are still excited about the rotation trade out of the work from home, stay at home tech stocks into the economically sensitive stocks, the reopening stocks, as we also like to call them. At the bottom was utilities. XLK was a loser on the day. But let's just take a look at the expense ratio on this particular fund, this ETF. Expense ratio is 0.13% versus 0.75% from ARK. And this one is up about 5% versus ARK, which is down about 10%, a little over 10%. So you have to be careful with what you're buying. The ARK fund is, to me, just a tech fund. And we're going to take a look at how ARK did today. It was off again, as we just looked at it before. And then I want to take a look at, and I want to talk to you about the ARK fund and why I think, I want to talk to you about how you need to look at tech stocks going forward. This is how you need to look at tech stocks going forward. And this is why I think all technology stock earnings are subject. You have to look at the situation, the background, the environment that tech stocks have been in. So with the pandemic, companies that helped you stay at home, work from home, and just basically stay in your home have caught a substantial bid. The stocks took off because their earnings and revenues went up so much because they became such helpful companies. You think about the DoorDashes of the world. You think about the Teledocs. You think about the Zooms. Think about Zoom. I would say Zoom is probably your most quintessential stay-at-home, work-from-home stock. Okay, so Zoom was like Kleenex. We call a tissue a Kleenex because of the brand name of Kleenex. And now when you have a conference call, you say, oh, let's have a Zoom call later. Not a video call, a conference call. We actually call it a Zoom call. So that's just amazing how that's part of the vernacular. Having said that, and you look at Etsy and other companies, you have to look at the environment in which they operated in. We had the perfect environment for the work from home, stay at home tech stocks. And now that they've come down, many of them, all the ones that I follow have come down. People are asking, hey, do you think it's worth a shot to buy these? Do you think it's worth a shot to buy some of these stocks or the ARK ETF? My answer is, are we going to have the same environment going forward that boosted these stocks and their earnings and revenues? I don't think so. We're going into reopening phase. And what does that mean? It means that people are going back out to restaurants, to hotels, but it doesn't mean they're going to keep ordering food in, watching as many Netflix movies. In fact, Netflix came out with a lower than expected earnings and revenues report, much lower than expected subscribership growth, and the stock tanked. Netflix is another quintessential work from home, stay at home stock. So Zoom has been crushed. Teladoc has been crushed. So my thinking is, unless we have another pandemic where we all have to stay at home for another year, I don't really see how we get back to an environment where these companies could flourish and show the same kind of growth that they showed in the last year. And that's why I'm down on the sector as a whole. And that's why I say all technology company earnings are subject. And on the other side of the same coin, I think all earnings are subject with the reopening stocks, the industrials, the energy, the financials, the airlines, because they're experiencing a sudden, spontaneous demand driven pop. So is that going to last over the next year or two? Or do we just get back to normal in a economic environment of low inflation and low unemployment, which is what we had before the pandemic started? This is why Ben Bernanke is convinced that any inflation we get, as strong as it'll be, won't be long lasting. It'll be transitory, temporary, because we've already seen low unemployment and decent economic activity that did not spark long-lasting inflation. And I think that makes a lot of sense. And I see the price of wood is up, and that has a lot to do with imports also. But the price of metals, the price of resins and plastics, everything is going up in price of food. But there are a lot of supply shocks. A lot of people are changing their buying habits from stay at home to going out again. And it's messing things up, and we'll get back on track. It'll probably take another year or year and a half. So that's my story for today. That's what I'm sticking with. So just to reiterate, we had the perfect storm for the work from home, stay at home tech stocks. That storm is over. So unless we're going to have another storm, then why would you think that we're going to have another surge in this cohort's earnings and revenues? Thank you very much for watching. Greatly appreciate it. And I will see you tomorrow.